Investing in dividend stocks is a great way to build long-term wealth and generate passive income. For beginners, understanding the basics and taking the right approach to dividends can make all the difference in achieving their goals. This guide provides an overview of dividend investing and offers practical advice on how to get started in this rewarding asset class. What is dividend income? Dividend income is a type of passive income that can be earned from investing in stocks or other forms of investments. It is a great way to supplement your regular income and can provide you with steady returns over time. This beginner guide to dividend investment explains what dividend income is, how it works, and the types of investments you should consider for maximum returns. The first major difference between regular income and passive income is that with regular income, you earn a small amount every month. Passive income sources are those which do not require the effort to be spent on them, like rental properties or selling things online. With passive income, you earn it regularly without having to do the work yourself. For those who are new to dividend investing, understanding the different types of dividend income is essential. There are numerous options available to investors, and it's important to understand each type of dividend income in order to make an informed decision about which one will best suit your investment goals. There are many types of dividend incomes, including cash dividends, stock dividends, and property dividends. We will also discuss the potential risks and rewards associated with each type of investment and offer tips on how to make the most out of your investments. What are cash dividends? Investing in cash dividends can be an exciting and rewarding way to grow your wealth. Cash dividends are payments made to shareholders by a company out of their profits. Not all companies pay dividends, but those that do provide investors with a steady source of income, as well as capital appreciation over time. The simplest way to invest in stocks that pay cash dividends is to buy stocks in the Dividend Aristocrats list, those companies with 1 or more consecutive years of at least 10% earnings per share growth. Dividend Aristocrats are usually large blue-chip companies with a substantial amount of shares outstanding and long operating histories. If you are considering investing in stocks with a dividend policy, make sure the company is financially stable, has strong profit growth prospects, and has solid earnings stability. Investing in cash dividends can be an effective way to build wealth over the long term. Dividends are a form of income that is paid out by companies, and the amount and frequency of these payments can vary from company to company. By investing in cash dividends, you can enjoy several benefits such as stability of income, control over the size of investments, tax benefits, and the potential to reinvest earnings into additional shares. However, it is important to be aware that there are also certain drawbacks, including potentially lower returns compared to growth stocks and fluctuations in the value of money due to inflation. For example, if a portfolio of dividend stocks experienced a loss of 30% and the same portfolio of growth stocks experienced a loss of 20%, investors in the dividend stock would have declined in value by 10%, while investors in the growth stock would have increased in value by 10%. Another potential drawback of investing in dividend stocks is that the potential for capital appreciation is limited and ultimately may not match the potential for growth. What are stock dividends? Stock dividends are a payment made by a company to its shareholders. They are distributed out of the company's profits, usually on a quarterly basis. Dividends can be paid in cash or in additional shares of stock, depending on the company's policy. They provide investors with an additional source of income and help to increase investor confidence in the stock market. Stock dividends are an important part of investing, and understanding how they work is essential for any investor looking to make informed decisions about their investments. Investing in stock dividends is a great way to grow your money, but it can also be complex and risky if you don't know what you're doing. Fortunately, understanding and investing in stock dividends doesn't have to be a daunting task. With the right knowledge and strategies, you can confidently invest in stocks and get the most out of your investments. A dividend is a form of income distributed to the shareholders in a company. The company's profit is divided into two parts: dividends, which the company pays out to the shareholders, and retained earnings, which are paid out to stockholders as they accumulate. These two streams of income do not come from the same source. Rather, they happen simultaneously over time. For example, let's say XYZ company makes $1 million in profit this year, but pays out all of its profit, $1 million, in dividends, $1 million. But let's also say that it takes 5 years for it to reach your dividend threshold of $2,000. So XYZ company has to pay the dividends over the next 5 years, $1,000 per year. What are property dividends? Property dividends provide investors with a unique opportunity to generate passive income and build long-term wealth. They are a form of investment where investors obtain the rights to receive a share of the income generated by an owned property, such as rental income or capital gains. Property dividends enable investors to diversify their portfolios and benefit from the financial security that comes with owning real estate. What are property dividends? Property dividends are financial payments paid to investors who have invested in a piece of real estate. Let's say that you own a property that generates $1,000 per month in income, and you put down $100,000 on the property, which means you have a 20% share of the profits from the property. Your equity is $100,000, and your yearly income is therefore $2,000. You may decide to sell your shares for whatever price you can get for them, and receive an amount equal to the sale price, x your percent share of ownership. Property dividends can be an attractive form of income for both businesses and individuals, as it provides a regular source of income without the need to sell your assets. However, there are certain advantages and disadvantages associated with property dividends that should be considered before making any decisions. Tax implications. The tax advantages and disadvantages of property dividends. The tax implications of property dividends can be broken down into two different areas: the federal income tax implications, which are discussed below, and the state income tax implications. Federal income tax implications. In general, a property dividend is not taxable as it is based on your investment or interest in real estate. However, this rule does not apply to all types of property dividends, and some sources specify that they should be treated as ordinary income. In general, a property dividend is not taxable as it is based on your investment or interest in real estate. Inheritance tax implications. When a property dividend is issued by your business or inherited from an estate, it may be subject to the inheritance tax. In general, these interests are not taxable because they are considered capital gains, but there may be exceptions if you own the stock for less than 12 months before you receive the property dividend.